Welcome to the Deep Dive. Today we're tackling something pretty interesting, a financial puzzle, really, from Tata Consultancy Services, TCS.
That's right.
We're looking at their Q1 FY26 results, that's for the quarter, ending June 30th, 2025, just approved July 10th.
Yep.
And here's the thing that jumps out. Their consolidated profit actually went up to nearly 12,820 crore rupees.
Which is about 1.28 billion US dollars.
Exactly, up from around 12,290 crore. But, this is the kicker, their consolidated revenue actually decreased, dropped from about 64,480 crore to 63,440 crore. So, profit up, revenue down. How does that work?
Well, it's a fascinating situation, isn't it? And what it really highlights, I think, is TCS's agility.
Yep.
It shows how they manage things.
Because
Because the profit boost wasn't really about selling more stuff, which is what you'd normally expect.
Right. Top-line growth.
Exactly. Instead, it came mostly from, well, two things. Really tightening the belt on expenses, and also a bump in what's called other income.
Okay. So cost control was key.
Hugely key. And when you dig into which costs, one thing really stands out.
What's that?
The cost of equipment and software licenses. For their consolidated results, this specific cost just plummeted
Plummeted how much?
by roughly 73%, quarter over quarter.
73%. Wow.
Yeah. I mean, think about it. It went from nearly 2,750 crore down to just about 725 crore.
That is a massive drop. Is that common to see such a drastic cut in one quarter?
No, it's quite rare, actually. Especially for something like software and equipment, it suggests a very focused effort.
Like renegotiating contracts maybe, or changing how they buy things.
Could be either or both, maybe optimizing what they already have. But whatever they did, that single change basically made up for the revenue dip on the profit line.
Incredible. And you mentioned other income too.
Right. That also played a part. It jumped quite a bit as well. Went from about 1,030 crore to over 1,660 crore.
And that's things like interest income, investment gains.
Yeah, exactly. Interest on cash, maybe some investment gains, perhaps foreign exchange benefits. You combine that extra income with the big cost cuts.
And you get higher profit, even if revenue is a bit soft. Makes sense.
Precisely. It really paints a picture of strong financial management behind the scenes.
Okay, so we understand how they did it. But let's talk about that revenue dip. Where did it actually come from? Which parts of the business struggled?
Good question. So if we look at the consolidated segment revenues, banking, financial services, and insurance BFSI, that's still their powerhouse.
Still the biggest chunk.
Oh, yeah. Brought in around 24,740 crore, and it actually grew, both compared to last quarter and last year. So solid demand there.
Okay, BFSI is strong. What else?
The category they just call others also did pretty well, especially year over year. Suggests some strength in maybe newer or smaller areas.
Got it. So where were the weak spots then? What dragged the overall number down?
Well, the main area was communication, media, and technology, CMT. That segment saw a really significant decline.
How significant?
Over 14% down compared to the previous quarter, and over 12% down compared to the same quarter last year. That was a major factor in the overall revenue dip.
Ouch. So CMT took a big hit. Any others?
Life sciences and healthcare also saw a bit of a decline. Not as dramatic as CMT, but still down both quarter over quarter and year over year.
So a mixed bag across the different business lines.
Very much so. Oh, and one more thing worth noting, the board declared an interim dividend, 11 rupees per share.
Right, so returning cash to shareholders even with these dynamics at play.
Shows confidence, or at least commitment to shareholder returns.
So, okay, let's try and wrap this up. What does this all mean for you, the listener, watching TCS?
Yeah.
Their Q1 results definitely show, well, impressive cost control, right?
Absolutely. Financial discipline, especially on those software and equipment costs, is clear. And it allowed them to grow profit despite that revenue softness. Very effective management of the cost base.
But is it sustainable? That's the big question, isn't it?
That's the provocative thought, yeah. Relying on such deep cost cuts, especially a massive one-off like that 73% drop, can you keep doing that?
Probably not at that scale.
Right. So while it's brilliant financial management for this quarter, you have to wonder about the long term. Sustainable growth usually needs solid revenue growth from your main business, wouldn't you say?
Generally, yes. You
Yep.
can't just cut your way to glory forever.
Exactly. And you also have to wonder if cutting costs that deeply could eventually impact service quality or innovation down the line. It's something to watch.
It's definitely a balancing act. A masterclass in efficiency this quarter, like you said, but the story isn't just about the bottom line.
Well put. The top line still matters.
Absolutely. Okay, before we finish, just our standard important disclaimer. We are not SEBI-registered financial advisors.
That's crucial.
If you are thinking about making any investment decisions based on this or anything else, please consult a certified financial advisor first.
Definitely get professional advice tailored to your situation.